The YouTube link that you sent me last time,
Okay.
uh, it is not mine.
Oh, someone else's. Okay, I will check that one. Okay.
Yeah.
Right. Yeah. So many.
I tried to listen. I was listening to my voice. I thought I sound a bit girly, but then I kept listening because
Right.
I've never listened myself before like that, and I
Uh,
kept listening and realized that's definitely not me because I didn't ask this question. So
right. Right. I will check it. I will. It may be some other one's one. Okay, I will check that one surely.
no problem. I'll keep that. If you send me
Yeah.
the my one as well,
Yeah.
that's
Right.
fine.
Yes, I'll do the. I'll process it and send it to you. Sure.
Thank you. Thank you.
Right. Yeah. So anything that you have been able to do on this case study, what I send it to you.
Not really. No.
Okay. So what I'm going to do is I'm going to look at some of the financials today on
Mm-hmm.
that case study. You
Mm-hmm.
remember in that case study, now the one thing you have to remember all the time, you have to see what is the
Yes.
date of their financial statements and what is the
Yes.
date of our exam.
Yes.
That is very important because now, for example,
Yes.
this exam, it was on somewhere in November 2016, just a couple of days back.
Yes. Yes.
And we have to see when is the financial statements given. The date of the
Mm.
financial statements very important because,
Mm-hmm.
for example, the strategic case study, the financial statements are given as at 30th November 2016, almost today,
Yeah.
the latest,
Mm.
very latest. Even before the exam, they have given the financial statements. In
Mm.
this case, if you really look at the financial statements as at 31st December
Mm.
2015. So we are
Yep.
11 months since the financial statements.
Yep.
So when we are talking about our financial statements, we have to be mindful what was there
Mm.
on the 31st December may not be there today.
Mm.
Lot of things would have happened between
Mm.
the January 1st and November. So
Yep.
always you have to look at that one whenever we are interpreting the financial statements. So the
Yep.
managerial case study, it was 31st December 2015. Strategic case study, which is just
Mm.
happening today, tomorrow, day after. The,
Yep.
the financial statements were as at 30th November 2016. So
Yes.
it's just one.
So because I'm taking the February intake,
Mm.
would that be so? We will be
Yeah, now when
considering
you
it
take the February
more
intake,
fresh.
you will have a new pre-scene. But
Yes.
what I'm trying to say is that pre-scene might say the financial
Yes.
statement as at 31st December 2016.
I understand. Yes.
Then
Okay.
then you are only 2 months away from the financial statements, which may
Mm.
be somewhat all right.
Mm.
Sometimes, now for example, in the same November exam, management
Mm.
case study, it was 31st December 2015. But strategic case study, which is happening
Mm.
today, tomorrow, 30th
Yeah.
November 2016. So today is 23rd November 2016. They are giving
Yes.
the statements as of 30th November, even before the financial year is ending.
Yes.
So probably the figures are estimated. You mean?
Yes.
Right?
Yes.
And I mean, not probably, definitely it is not audited.
If it's not already. Okay.
It's
Yeah.
not audited. So because of
Mm.
that, you have to be careful in interpreting the statements because what is not audited can have lot of areas for
Where? Yeah.
problems. But this
Mm.
statement, 31st December 2015, by the time you come to November 2016, surely it is audited.
Mm.
Right? And the other thing I want you all to look at all the time, look at this heading. Vodafone consolidated statement of financial position.
Mm.
So that really shows it's not only one company, it has a number of subsidiary companies.
Yes.
Right?
So
Similarly,
are we just quickly reminding you, are we recording this? Yeah.
yeah, I'm recording. Yes.
Because
Yeah.
I'm gonna go through with this anyway. Tonight I'm planning to just go through everything. Just
Okay.
like
Right. I'm recording this one. Right. So
that's fine.
what I want to tell you is these are very important important points sometimes which we miss in the exam, which is going to be very important from all our point of view. So when you say consolidated statement of financial position, surely that means it's not the single entity, it has some subsidiaries.
Can you explain that a bit more?
Pardon?
Can you just elaborate that a bit more?
Yeah, basically now any company will prepare their own financial statements.
Yes.
And in addition to that, if a parent has some subsidiaries, the IFRS 10 says a consolidated financial statement should be prepared.
Oh, this is because if you have a parent company, if you're not on your own.
You are a parent and you have some subsidiaries where you have invested monies and where you are controlling some subsidiary companies.
Yes. So you make the consolidated statement because of that.
Because of that one. You have to prepare separately the parent company's own financial statements and also prepare the consolidated statements comprising the entire group. Now that most likely because since you have not done the early exams, you may be little bit out on that area. What is meant by consolidated?
Also, I need a bit help with reading the statements and a bit more.
Right. Okay.
Yes.
Right. So we will do that one. So if you look at this statement of financial position, you can see there is under equity attributable to the owners. And also you have to remember the figures how we are going to read it. Now this time the figures are $million.
Yes.
Right. That means all these figures are 20,496 million.
Yes. Yes.
And the top is million, right? It is 20,400. In other words, it is 20.4 billion.
Yep.
So you have to read the figures very carefully, otherwise you might make certain mistakes. So, for example, this one, it is $F millions, and in the strategic case study, it was just H dollars.
Sometimes it can be thousands as well. 0.
Yeah, can be thousands.
Yeah, in that I do case, understand that.
Yeah, in that case, it is 20,496,000.
Yes, it can be, yes.
Yeah.
I understand that bill. I understand because I do go through that my normal hotel management work.
Yeah, you have to be careful because different exams will have different. So remember these things to look after all the time because your calculations will depend to a great extent on these areas.
Yeah.
Right. So what I was trying to tell you was you have to look at the date of your exam and look at the date of your financial statements. What is the gap?
Yes.
That is very important because when you are going to comment. Now, for example, in this balance sheet, in this statement of financial position, there are 10 billion cash as of 31st December 2015. Now, for us to assume that we have the 10 billion as at November 2015 is something which is risky. Because maybe during this period, you have invested on something and you may not have money.
Yep.
So for us to think that we have 10.4 billion and to say that we have no problem of cash or whatever is dangerous unless you have some information to that extent. Now you can see another thing in this company. If you see normally, now you are doing business, you don't want to keep big cash balances, isn't it?
Yep.
You don't want to keep big cash balances. You want cash, just the minimum.
Yeah, you rather invest it or
yeah, you rather because the cash per se is useless. Right?
Yeah.
Cash is, we want cash, but the cash just having it in the bank current account is useless. It's not going to make you any return. And you can see in this funny company, if you really look at, the biggest asset is cash. Look at the goodwill, 282 million.
Yeah. Even trade receivables are even
Trade receivables also fairly big, but the cash and cash equivalence is very big. Normally receivables
will be higher. Yeah.
Normally receivables, inventory, those are the things that you need, and the property, plant and equipment. Cash should be the minimum, and most of the companies who will have a a small cash balance or even sometimes a negative cash balance, overdraft.
Yep. Yes.
Right. So you can see this company last year, 31st December 2014, 7.4 billion. 31st December 2015, 10.4 billion. So you being the management accountant, something radically wrong because you are just accumulating cash. We need cash for three purposes. You can note down. We need cash for three purposes. One is to do the transactions, what we call transactions motive.
Yes.
Transactions, because you can't show you can't invest all the money in property, plant and equipment, and you can't tell the employees, look here, we have assets. You work, looking at the assets. Or you can't tell the electricity man, we have assets. We can't pay the electricity bill.
You have to make, for the financial transactions to go through, you have to have the cash.
Yes. The transactions motive. The second reason why we keep cash is what we call precautionary motive. For an emergency. For an emergency, we must have something in short-term fixed deposit or something like that, which we can pull it out for an emergency. Third reason why we have money is what we call speculative motive. Speculative. That is, you keep some speculative. That is, you keep some money, in the event of some raw material prices going up or something like that, you will speculate and try to stock up additional stocks. These are the only three justifiable reasons for us to keep money.
Not a big difference between emergency and the speculative.
Emergency is more of for a crisis. Speculative is more of a kind of trying to exploit a kind of a situation in the market.
But just in case, if the prices go really down, you buy a lot of stuff.
That's correct. Or maybe when the price is going up also, if you speculate the price is going up, you will buy it and keep it.
Before they go up.
Before it goes up. Right? So during this budget time, all the people, they try to keep some money and stock up something and keep it. Right? So that's the normal three reasons. If not, we must invest this money in property, plant and equipment as much as possible. Invest in the working capital like inventory and receivables. If you don't have any investment opportunity, you must return the cash to the shareholders in form of dividends.
Sorry, what's the last piece you said?
Yeah, if you don't have any investment opportunity, you must return the cash back to the shareholders in form of a dividend.
In form of a dividend, yes.
Yeah, because the shareholders can then go and invest elsewhere. If you are going to retain the money of the shareholders, this is all shareholders' money. If you are going to retain the money of the shareholders, it must make a return for the shareholder.
Yes.
That's the basis for financial management. And you can see another.
What would normally, hardly would you would see, I would assume, that managers are actually getting the money back. They're always investing, aren't they? You're doing the risk.
Correct. You must invest.
If you have the money, you don't give it back. You just, you do
the risk management. You have to invest. You have to invest it. But sometimes what happens is you don't have good investment opportunities. To invest, what we do is we do an evaluation and see whether the net present value is a positive project. In that case, we invest. But at certain times in the economy, you may not have
risk management.
You may not have any investment opportunities. Country is going through a bad period. In that case, the best thing, if you can't manage it, if you don't have, you have to, every company, every board of directors should be looking for new investment opportunities. That is the way to grow. So there are two ways of growing. One is what we call organic growth. That is, you try to enter with the same products to the new markets, or you try to enter with new products to a new market or same market, that kind of a thing. That is what we call Ansoff matrix. Existing products, existing market, existing products, new markets, new market, the new product, existing market, new products, new markets. That's what we call the Ansoff matrix. That's how we can expand the business.
What's that called? Which matrix?
It's called Ansoff. I will send you a little bit of a note on that one. This is very important. These are the technical models that you should be looking at all the time.
Economics, yeah.
It is Ansoff. Right?
Okay.
It is Ansoff matrix. This is the theory here is basically your starting point is you have an existing product and existing market. This is your starting point. So what you can do is, then you can move into the new market with your product. Now when you start a business in UK, you can later on move from UK maybe to America. So existing products.
Yes. A new market.
New market. Right. Then what happens is, okay, the product is, it has a life cycle. It goes off. Then what you do is you do a new product.
New product, existing market.
New product, existing market. Right? That's the third stage. You introduce a new product through research and development and go to the existing market because you have a good brand name in the market. You can do it. Then once that is exhausted, the next thing is to go for new products, new markets. So existing products, existing market is the starting point. Existing product, new markets is what we call market diversification. New products, existing market, product diversification.
Yep.
New products, new market, it's a total diversification.
I think it's most of this is common sense, but I think
it's the common sense that the people have developed various theories, various matrices, and it's really common sense. But people have developed all these things because now we have some kind of a way to go forward. Otherwise, what happens is you will be going all over. So we have a kind of a sequence to go to. So this is one way to grow. This is what we call organic growth. What is the next way to grow? The next way to grow, it's happening all over USA, all over UK, to acquire another company, acquisition and mergers. You are in the business of telephone manufacturing. You go and buy another competitor company in the same telephone manufacturing industry. So immediately you increase your market share because you have a 35% market share. Your competitor has a 25% market share. If you can buy that company, then you have a 60% market share. You control the market. So that is what we call the horizontal integration. That is, you buy a company, you acquire a company which is in the same trade, maybe one of your competitors, maybe one time a small company, whatever it is, you want to expand your market share.
Yes.
Right? That is what we call a horizontal, same level.
Lesser competition.
Yeah, lesser competition. Lesser competition, economies of scale. Economies of scale, all that can come up and way to grow.
Yes.
Today, if you really look at the magic word in business world, is the key word is growth. No company can survive without growing. To grow, the way forward is to invest.
Yep.
Invest on positive NPV projects. That's the way you will grow. So you have to look at continuously for new opportunities, new ventures. This is what the board at the strategic level will be looking all the time. Right? The next way of an acquisition and a takeover may be, now for example, in this company you are manufacturing phones. You need lot of material.
Mm.
You need people to supply the phone screens. You need people to supply the phone batteries. You need some people to supply the operating software. Many things that goes into the phone. You have to buy it from outsiders. You remember I showed you in this company, 96% of your cost is all purchased items, procurement.
Yes.
So you have to buying at a large scale from others. So you are dependent on your suppliers for the supply. If the suppliers fail to supply the batteries, you can have the best phone, but you can't sell it without the battery.
Mm.
So you have to have, so the way forward is for you to take a grip over your main supplier, the battery supplier, for example.
Yep.
So you go and buy a company that is supplying the batteries. Understand?
Okay.
So you have a control over your supply.
Mm.
Now here there are many suppliers, but there are companies who depends on one particular supplier, two suppliers. You try
Major
to,
supply.
yeah,
Yeah.
that is what we call vertical integration.
Mm.
Vertical integration. So we do not know this consolidated statement. They have not told us what are the subsidiaries. It may be they have some raw material supplying companies as subsidiaries, right? It may be that they have bought another competitor as a subsidiary. It can be anything that becomes their subsidiary, but finally we know because they are preparing consolidated statements that they have the Portaphone is the parent and they have subsidiaries.
Mm.
And also you can see on equity there's something called non-controlling interest. What is this, Suhail? Non-controlling interest. Any idea?
Not really.
Yeah. Now when you buy a company, when you take over, say this is the Portaphone. So let's assume Portaphone is buying another company that is manufacturing batteries, called battery company or B company. Now, Portaphone can buy entire 100% holding of this company. In that case, it becomes, the Portaphone becomes the parent, the B company becomes the subsidiary, and it's a fully owned subsidiary. No outsiders, completely owned by the Portaphone. So Portaphone will have to consolidate because there's a parent and a subsidiary relationship. In accordance with IFRS 10, they have to consolidate. They have to prepare, in addition to the Portaphone's financial statements, they must prepare consolidated financial statements.
Yep.
Sometimes in the B company, they might not buy in the 100%, they might buy only 80%. 80% share. In that case, still they can control, because so long as you have anything over 51%, you can control the company. What do you mean by controlling? You can take decisions. Your directors can take decisions because you are controlling that company. If you are holding
you're still the parent company?
Yeah, the parent company can control the subsidiary.
No. If anything over 50%, you'll be called the parent company then, yeah?
Yes, that's correct. If it is anything over 50% only, the company P becomes parent and the company B becomes the subsidiary.
Yes.
When that relationship exists, the company P, in addition to preparing its own financial statements, must prepare consolidated statements also, additional. So as I said, if the company P has anything over 50%, yes, P becomes parent, B becomes the subsidiary. If the company P owns 100%, P becomes the parent, B becomes the subsidiary, a fully owned subsidiary.
Yeah.
If the company P holds 80% and B in the company B, and if there are 20% outsiders, still you have to consolidate, but that outsiders interest is shown as non-controlling interest.
I see. Okay.
Non-controlling interest. So that means if there are companies in your group, this is what we call a group of companies. In your company, if there's a group of companies with some having anything less than 100%, then that means there are some outsiders in the group. That amount is represented by non-controlling interest. So this is how.
What sort of equity would that be? Can you give me an example, or what sort of like?
What sort of equity? No, because now let's assume that this company B, company B has a share capital of 100 million.
Yes.
Company B has a share capital of 100 million. Company P, our company,
yes,
buys 80 million shares. 80 million worth of shares of company B is bought by company P.
Okay.
Equity means only the voting shares. Now there can be shares, preference shares, which you have no voting rights. When you have voting rights only, you really can vote and control the company. You can appoint directors, you can appoint remuneration, all that.
You make the decisions.
You make the decisions. That is what we call operating decisions and financial decisions. If you are holding 20% in that company, you can't make decisions. The others will make decisions for you.
Yes.
But when you are holding 80% kind of a thing, anything over 51%, generally it is assumed you have the control. But even though you have control, there are outsiders holding 20 million of this company shares. So that 20 million, because since you have taken the entire consolidation, means you had all the assets, you had all the liabilities. But you must say, when you add 282 million, when you show 282 million as the assets of the company, goodwill, we know some portion of that belongs to the non-controlling people. So that is the part of consolidation. I suppose we may have to do a little bit on the consolidation accounts for you, because since you are not done, because in the F2 area, big consolidation. So I want you to...
F2 is my biggest weakness, I think. Yeah.
Yeah, I think so. What I would suggest is, as much as you start reading E2, start reading F2 also.
E2 is more theory. Whatever I've gone through before.
E2 is more theory.
Interesting concepts, interesting theories,
Yeah.
a lot of comments,
right.
a lot of but F2 is more mechanical, more formulas, more preparing accounts and statements and knowing exactly where to put.
Exactly. So there you need to do little bit of work. So we will do some work on the F2 area, particularly because in CIMA the consolidation is the big area, and that is all tested in F2. So what I would urge is you to start reading on the Pascals.
Okay, yes.
Right?
Yes.
We will do couple of sessions on the consolidation, not the real calculations part, but to know the theoretical aspects, when to consolidate, when to show it as an associate company, all that.
Brilliant. Thank you. Thanks so much.
Because you need to do something on that one. So you have to know the consolidation part, you have to know the associate part, all that.
Yep.
Right? So this is what we have to look at all the time. Right? Yep. So what I'm trying to tell you was, we have to look at when you say, if they have said portfolio statement of financial position without the word consolidated, that means only the single company. But the moment you say consolidated, that means it's a group.
Yep.
Right? So you have to look at from that angle. Right?
Yep.
So few things like that you have to know about a company and all that. So now what I want to look at is, I just want to quickly tell you how to go to the finances. Their revenue. They have a 39,712 million. That is 39.7 billion is their revenue. 39.7 billion is their revenue. Last year it was 34.8 billion revenue. Right? I want to Just last time I showed you the sales. 2015,
Yes.
the number of units sold was roughly about 82 billion sales.
Mm.
So what I did was I divided that 39 billion figure from the 82 billion figure to find
Mm-hmm.
out the average sale or the average selling price per unit.
Sorry, I lost you there, Kumar.
I'll come back to that one. You remember I told you the sales were 82 billion,
Mm-hmm.
82 million, total revenue 39 billion.
Mm.
What I did was I divided the 39 billion, the total revenue, from the total number of sales units to find out the average selling price per unit.
Yes.
So it came to about 484, so shall we say 500. So the average
Mm-hmm.
selling price per unit of a telephone is $500 or
Mm.
$484 average.
Mm.
Right? So this was a very important information what we had. Now what I'm going to look at is that we will go through the pre-scene as we go along, because actually I'm not interested in going through the entire pre-scene of this company because this is not our company. We will have a new pre-scene coming up. But what I want to show is how to approach the questions with this kind of a thing.
Mm.
Right? So what I want to do is I want to today look at a particular mark. Just
Sorry, Kumar, I can't hear you very well.
when I'm writing, you can't hear me. So don't worry. When I'm on the
Okay.
screen, you can't hear me. It gets disturbed, right?
Okay. Okay.
Yeah. So today what I want to do is, without going too much into the pre-scene, I want to start on just to show you what kind of a question can come up
Mm.
on the unseen. So I told you there are 4 sections of 45 minutes each.
Yep.
180 minutes is the exam. 45 minutes, the first section you will have a 45 minutes. You will not know what is in the second section till you complete the first section.
I see.
Unlike in
No.
our paper, we don't see the entire paper and where we can decide what to do, what not to do, all that.
There is no breaks or anything.
No breaks. No breaks. Right up to from the first minute to the 45th minute, the first section will appear. You can write, do whatever, anything. On the 46th minute or the 45th minute, the last second, it just disappears. The new screen comes up.
And do you type or is it handwritten or?
Type. You type it on the screen. It's like a word screen. You type it on the screen.
I see.
So whether you do it or not, on the 44 minutes 59 seconds, it's gone. The new screen, the section 2 will appear. Even if you do the first section 45 minutes in 35 minutes, whatever the reason, you can't carry forward that 10 minutes saving to the next section.
You have to wait, yeah.
Yeah. Immediately the next section will start and next section will go, then the next section will come, next section will go. Like that it will continue. Understand? Right? So, as I said, you will not see the second section till you complete the first section.
Yep.
So you have to look at from that angle also. So, and then as I told you, you are working in a company. So it's not like a question paper. Whatever you have written in the first section, now say for example, you are the management accountant, I am the chief executive officer of the company, and you write to me something about the first section. In this case, it's about opening up an airport outlet or something like that. And you write whatever your views in the first section. Now, in the second section, you can't contradict what you said in the first section.
I see.
Because you are working in the same company. 45 minutes back, you told me open up the airport outlet. Next 45 minutes you can't say, no, don't do. Understand?
So first one, you have to be very careful how
you have
you
to be
state
careful,
it.
you have to have a flow. You have to
Yeah.
know the flow. What you wrote in the first section should be continued to the second section if there is a relationship. Generally, there is a relationship. So these are the common mistakes the students do. They think it as an exam. They forget about the first 45 minutes what they have written, and then they think of the next thing. They totally think of totally different way and try to write it, which is wrong. Because if you are working in the same organization,
Yeah.
you can't tell something today and another thing tomorrow. So these are the things. So in a nutshell, to tell you this case study what we had in the November, they were one of the largest phone manufacturing company. They were a worldwide manufacturers. In other words, most likely they were manufacturing in one company, in one country, but they were exporting to Asia, Europe, USA, and other countries, Middle East, etc. And they were basically operating, most of the phones are bought by the mobile operators. Now you and I know phone is useless without a connection.
Yep.
Connection is useless without a phone. So both the parties, both the operators, the people who provide the network connection and the phone manufacturers must have some kind of a association. Now, for example, right at the moment, Samsung, they sell their phones. Apple, they sell their phones. People will buy whatever the connections they want.
Yeah.
Different connections. Now, if you come to Sri Lanka, you probably want to buy a local number, a Sri Lanka connection. Because if you use your UK number, you will have to pay roaming charges, which will be very costly.
Absolutely. Yeah.
Right? So even in your country, there may be many people, many operators providing the connections. You will decide whoever who is best, who is fastest, this, that, and the other, good customer service, and you will decide it. Just like the phone, the Apple, you said, you will have some loyalty towards the operator also.
Also, what they've done now recently, I've realized when I travel Europe or back home to Pakistan, so if I'm on O2 in UK, it will change into a local company like Mobilink, or it will change into. So they have their own, I don't know if it's an understanding or if it's like I don't.
Yeah, that's correct. Yeah, because now most of the people, most of the countries, most of the operators, they have their own link, like this travel agents kind of a situation. They do have an operator link also now. That's a newest trend. So as you come down from the airport, you can get a new connection connected to your one.
Never used to happen before, but now it happens.
It is happening now. That's a new trend. Now that's a very good thing what you told me. Now in the phone industry like that, there are a lot of new developments. So we have to be little bit aware of all those new developments also when we study these cases.
Yeah.
So basically in this company, they are big company, 82 million number of sales. So if you divide it by 12 months, it's about 7 million to 6.5 million number of sales phones for a month. If you divide it by 30, it works out about 200,000 phones for a day. All over the world. But they are selling about 220,000 phones for a day. Right?
Yep.
So big business. And they have given us another competitor called Moltone. They also sell almost a similar kind of a revenue. So they also probably having same numbers, because the phone industry, you can't have such a big difference in the price because it's a very competitive market. For your uniqueness, you can have a premium, but the prices will have to be somewhere closer.
Yep.
So what I did was I just worked out a little bit of a mock on a totally different concept. Now in the airports, wherever you come, whatever the airport you get down, you will have this mobile operators shops in the airport lounge. Right? I was in the airport last week to bring my daughter and son-in-law, and I saw everyone who comes up, not everyone, I mean most of the people, the foreigners who come, immediately they go to that shop and they want to get a local number.
Local SIM card, yes.
Yeah, local SIM card. Right? But very unlikely they are going to buy a phone.
Absolutely, yeah. What I make sure, like when I'm traveling and if it's a new phone, so I like iPhone 7 that I mentioned. Obviously, the companies don't unlock it for you. So what I do is they give you 3 months, I think, after 3, because it's a 2 years contract. So they know you're not going to run away or anything. So after, and they also obviously see how long you've been with them, loyalty. So after 3 months or 4 months, you can just say I'm traveling. And can you just unblock it? So you have to just make sure. If you unblock it, then you can just land in the new country and put the SIM card and start working.
Yeah, right. You can always do that one. You can block it here, and once you go, you can, But sometimes, now I know when my children are very young, whenever I go to Singapore, they say buy, they say the latest phone model, and they say that can you bring me that phone? So at certain airports, you buy a phone, because the phones are duty paid items. So sometimes in the airport you might find the duty free phones which is cheaper, and you might buy it.
Just like perfumes and fragrances,
perfumes and all that kind of a thing. The phones also, it can be duty free, because some phones, they have the school of thinking is phone is a luxury thing, and the governments are imposing a lot of taxes. So in the airport you can buy it duty free. Perfumes, chocolates, all that kind of a thing, you can buy it. Singapore airport, you can buy it duty free, the latest models.
A nice bottle of wine sometimes.
Yeah, that's correct. Yeah. Most of the people go to the duty free for that purpose. But these kind of things are also available in the duty free.
I see.
So what I did was I just worked out a little bit of a mock with my students to explain this concept. So this is what happens. Early morning you go to office, you find an email. Now this is from the person called Leo Chan. Now you are the finance manager. Leo Chan is the senior finance manager. He is your immediate boss. So as you come, you can see an email from him. This is about airport outlet. So Ireland is the country. So as I said, they always put a fictitious country. So for this phone company, the country was Farland. Right? So Farland is constructing a new international airport in South Farland and is in its final phase. The airport operator has offered our country main mobile operator, Mobitel, to open a retail outlet in the duty-free area to sell mobile phones and connections, mainly to arriving passengers, and mostly they will be on pay-as-you-go type. So in this company, in this country, the phones are bought for 2 types. One is what we call prepaid and postpaid. The prepaid phones, they buy they buy the phone and they pay monthly, end of the month, the bill, whatever.
Contracts, yeah.
Yeah, on a contract basis, you pay, you have kept a deposit or something like that. Then you are a loyal customer, they'll give you all that, and then you pay monthly the bill. You give a standing order to the bank or whatever, and it is paid. Sometimes we have what we call this prepaid, the reloading. It's not a monthly bill. As you come down, you will, so this is what's happening in pay as you go. Now, if you go to another country, you may not have a, unlike in what you just now said, in another country, you may not have a account. You go and get a kind of a SIM card with preloaded with $50 or $100 or something. Once it is over, you will get a new card or whatever. That's the way you will reload it. So this is what they were saying, pay as you go.
Yes.
Pay as you take the telephone calls. So Mobitel is their main operator in this country. So they have got a contract, or they have got a contact from the airport authority. saying for them to open up a shop exclusively to sell phones and connections. So Mobitel in turn is coming to you and saying he is offering to sell our phones exclusively in their outlet with their connection. So it's a partnership. Right? It's a partnership. So we are a telephone manufacturing company. They are the mobile operator. The airport has offered the mobile operator, and here operator is inviting us.
So the network provider is contacting us as a phone. Oh, yeah, okay.
Exactly. Right? Network. Now you can see what the network provider is proposing. They propose we pay the rent for the duty-free area for an initial period of 3 years. We will have to pay an initial deposit and annual rent. We will also have to fit out the shop with the shop fittings, carpets, etc. on our own expenditure. This will open us an opportunity to sell our phones at duty-free prices in partnership with Mobitel. So we have to put the initial outlay. We have to put the carpets, we have to put the deposit, we have to put everything, and we will, in partnership with Mobitel, we will be selling phones at the airport.
They will be paying, we pay the rent, duty free.
We have to pay. So we have to pay. Our company will have to pay everything.
So we have to pay everything. 3 years we have to pay the deposit.
We have to pay the rent in deposit. We have to pay the rent in deposit. We have to pay the rent. We have to pay the carpet, everything.
I think because they have the contract with the airport authorities.
Exactly. Because we did not get a contract, they have got the contract. So they are using that opportunity for them to do business on an investment free basis. They want us to make the investments.
And I suppose in this situation, this is not contract binding. So anybody from if you are working for Mobitel, you probably would contact 3 or 4 network providers same time.
Exactly. But here they that's correct. Right. Here they say this is an exclusively for us.
Yeah.
So they say exclusively given as the Mobitel, are keen to have an exclusive phone shop in the duty free. So we can sell our phones exclusively, no other competitor will come. But if we miss this opportunity, Mobitel may team up with Moltone. Moltone is our main competitor. So it's an do or die battle for us. It's a prestigious opportunity for us to sell our phones in the airport. Far and South, the airport served only a small number of domestic flights. Right? The authorities are still to reach an agreement with any large international airlines, but they are confident they will attract some international airlines within next 6 months. So right at the moment, it's a domestic airport. So in a domestic airport, there is no question of a duty-free kind of a thing happening. The people are traveling in the same country. They will not be interested in buying phones or whatever, no duty-free concession. But if it is converted into an international airline, there will be passengers coming from UK, USA, all over. They will probably like to buy a phone and a connection. But now you will picture this one. You have to picture, right? Many will buy a connection. Few will buy a phone. Isn't it? When you come to, many will buy a connection. Few will buy a phone. If you come to Sri Lanka, you are not going to buy a phone from Sri Lanka, no? You will have you will bring your i7 from UK and use it with a Sri Lankan connection.
I think I'll be using the connection definitely.
Yeah, right. You will use the connection. Unless this phone is something super, it is not available in UK, you come to Sri Lanka and buy it duty free.
Absolutely. Also, one more thing they've done now, Kumar, in Europe, from this year, last 6 months, 7 months, I would say, this year, they've started free roaming charges now. So before, Back in the for 2 years ago, because we have to have a car insurance in UK and Europe, it's a must. So and it used to be, oh, you pay extra £50, extra £100, or it used to be, and then it started doing free car insurance for Europe, covering the whole Europe. Breakdown cover. And now they started doing with the network providers the free roaming charges. Free. So every month, if I go see my partner, so she, if I think I get 100 per month every month, or 200 like that. It's quite good.
Yeah, right. So in fact, there may not be a need for you to buy a new SIM card.
No, not at all. No.
Not at all.
And you also get internet. Kumar, you also get internet now. So like here you have 4G. So wherever in Europe there is 4G, I will get 4G, and wherever they have 3G, I'll get 3G. But it's there. Yeah, it's free.
Yeah. Right. So you can see how the developments are happening. So now for example, right at the moment in this country, they may not have these things. But 3 years is a longer period in the phone industry. People may not want to do any connections or any phone. They will just walk out of the airport with the connection. They will not even drop in at your airport shop. So here you are going to invest money. You are going to sign a 3-year contract, and this is what is going to happen. And so far, the airline itself is not an international airport. So today, you come and sign an agreement in your country, right? And the authorities say, yes, it will be converted into an international airport. It's a risk. If it is not get converted, or if there are no airlines coming in, now Sri Lanka, recently the previous regime, they put up a huge airport in the southern part of this country, wanting the international flights to come to that. But no international airline has agreed to land the phones in to land the planes in that part of the country. So the new regime that came into power in 2015, they have converted that into a paddy storing store. After spending so much, the new regime, the new government that came into power in Sri Lanka, what they have done is they have converted that entire new airport that was constructed by the former government to store paddy.
Oh my God!
Yeah, it's a crazy thing. That was the silly political, revenge kind of a thing. But national funds.
Basically, they don't want because if they finish the construction, then the opposition will say, look, this is our project.
Exactly,
we are the one who started.
Exactly. So these things happen in Pakistan, Sri Lanka, India, these countries.
All the time. 80% finished hospital, 80% finished university, IT college left.
Yeah, right. So all these things do happen, and finally, at the end of the day, so what I was trying to tell you was, no airline was prepared to land it on that part of the country, because the problem was there were a lot of, it was like a sort of a natural bird park that was converted into an airport. So still you get a lot of birds, and the airport, the pilot said they can't take a flight there, because with so many birds around, it will be very difficult for them, the visibility and all that. So it was a failure, but the former president of the country, he wanted to have an airport by his name in his own electorate. So he went and spent all the public money and did, and the new government came. New government, they wanted to scrap the whole project. So anyway, so there's a risk always in these things. So Julie is the marketing director. She has drafted an investment appraisal for the project. Now, this is another very important thing. In a case study, you must know who is preparing what. Now, you and I, we know when the marketing department people prepares a project, it is always added with lot of sugar.
Absolutely.
Salt, everything looking very tasty.
Sales tactics, yeah.
Looking very tasty, because their minds are trained in such a way, they are very optimistic people.
Yes.
We accountants, We are on the extreme other end. We are very conservative people.
Practical, yes.
Yeah. That's why no wonder the accountants and the marketing people, they clash each other because it's two extreme ends. So whenever, now that is a very important thing in these case studies, you must see who has prepared this report. If it is coming from the marketing department, you can surely assume that it is an optimistic one. So Julie is the person, the marketing director in this company. She has drafted an investment proposal project. Julie has asked my comments within next 60 minutes. So your immediate boss says comments within next 60 minutes, and the boss is passing it to you and say, please do it to me within 45 minutes.
Yeah.
So your boss is very specifically mentioning few things for you. My one immediate concern is the discount rate that has been used. So we know when we are doing net present value investment proposal projects, we need to discount that cash flows into what we call to bring it to the present value. Now, have you done that one in your earlier studies or anywhere?
What was to say that again?
About the net present value calculations,
yes.
Discounting cash flows.
I've done a bit of everything really, yeah.
Okay, good. So just to refresh yourself, but why do we do that one? Because we know today's 100,000 and next year's 100,000 are not the same because the money depreciates with the interest rates, and therefore we have to, the fourth year 100,000 may be worth only 75,000. So we have to bring it to all the present value.
They normally give you the rate of depreciation as well, don't they? Like
they give you the what you call rate of discounting.
Yes.
Rate of discount. Normally the rate of discounting in the early examples they would have given you, but actually the rate of discounting is your cost of capital. What do you mean by cost of capital? Now when you take money, whether shareholders' money or the lender's money, you have to pay a return to the shareholder, return to the lender. And when you mix up the money, both the loan capital and the share capital, you have to pay two different returns, one to the shareholders, one to the lenders. When you take the average of that capital, the return what you have to pay, that is your cost of capital. To the shareholders, you have to pay cost of equity. To the lenders, you have to pay cost of debt. When you take both the things together, that is the overall cost of funds for you. Just like the raw materials are costing you something, just like electricity is costing you something, funding also costs you. You have to pay something for your funding. So the overall cost of debt funds is what we call weighted average cost of capital. Weighted average cost of capital, or commonly we call it WACC. Weighted average cost of capital.
I see. Weighted average cost of...
Yeah, weighted average cost of capital. This is what we call WACC. So, say imagine you have borrowed money and you have taken shareholders' money and the cost of capital is 12%. Imagine, right? 12%. So, if you are going to invest that money on a project, that project must bring a return more than 12%. After investing in a project, that project must bring a return more than 12%.
Absolutely, yeah.
Because you have to pay 12%. If you are going to get, if you are going to get 11% return, then the project is not viable.
It's a loss, yeah.
It's a loss. That is what we do with that net present value discounting. We take this cost of capital as 12% and then we work out the net present value. If the net present value is positive, That means we are getting a return more than 12%.
I see.
That is why we say it's a good project. After doing the net present value calculation, if the net present value is minus at 12%, then it's a bad project. So that's what we do. Even though you may have done, you may not have thought about it in that way. This is the exact meaning of what we call positive NPV projects minus NPV project. So you don't want to do a minus NPV projects.
Absolutely.
Right? If you do positive NPV projects, the company will grow, shareholder wealth will increase, and that is what we should be doing.
As the manager, yes, finance manager. Yeah.
As finance manager, as the investment manager, this is what we have to look for projects which can bring you a return much more than cost of capital. So it's a twofold attack. One is to see whether we can get very good projects with a high return.
Yep.
Secondly, we must try and see whether we can reduce the cost of capital.
Yep.
Instead of taking it at 12, if we can get it at 11, then we'll be the better position to do a project rather than trying to get it at 12. So this is what our finance management has to do, right? So basically she's asking, our Leo is asking, the immediate concern is the discount rate that has been used. Julie has used our existing WACC, that is our present cost of capital, which we use as a benchmarker, and I'm unsure whether WACC is an appropriate rate. So he is questioning whether the present cost of capital, whether we can apply for this new project, whether it is all right. Number one. So we have to note down and then we have to attack separately.
Say again?
We have to note down what he is asking and then we have to answer according to that one. So here you can see Leo is asking two things from you. Please reply as soon as you can with your thoughts on the following. Although I have no doubt that calculations are correct, I'm unsure about the assumptions underpinning the cash flow that Julie's department has made here. What do you think? So you and I and Leo knows Julie is a marketing person. So when Julie prepares statements, she will make lot of assumptions. So she's asking, our Leo is asking, do you think these assumptions are correct? Because when the marketing department prepares, they will think of the sky. They'll think of the sky. They will say, we can sell, so many number of units. So you have to see whether taking those financial figures, what I have done, whether these numbers are realistic.
Yeah.
Then the second one is whether the WACC, the WACC is the weighted average cost of capital, which they have applied, whether it is correct, right? And if it is not so, whether there is any alternative way to do it. So generally in a 45-minute paper, we find two tasks, generally, like 1 and 2 here. Sometimes, rarely, you might have 3 tasks, but still 45 minutes time. So normally, in a 45-minute paper, later on when we are doing, we will take it up. We take about 15 minutes to read the question. You have to carefully read that again and again, find out what is asked. 15 minutes. And we must keep the last 5 minutes just to, nicely wrap up. Because, wrap up. So when you take 15 plus 5, 20 minutes gone, then we are another left with 25 minutes to write the body. Whatever we have to write. Right? So when we write 25 minutes, there are 2 tasks. So we will try to equally divide it, say 12 minutes or something like that to plan the time. So at the moment, we don't need to worry about timing. That we will take it up later on. But I just want to tell you how we will approach it.
It's a good technique, yeah.
Yeah, that is what I have been always doing. So we will try to work through that one. Now you can see, this is what we call the reference material. This is what Julie has prepared, right? So Julie has prepared year 0, year 1, year 2, year 3. So remember, the contract is for 3 years. So she is estimating 360 million first year revenue, second year 378 million, 397 million. She has taken the discount at 30% out, and then rent deposit of 60 million, fittings 31 million, rent for the 3 years 40 million, 40 million, wages 36 million, 36 million. Then she has taken the discounting factor, and finally she has arrived at a 385 million plus NPV. So we don't need to go and look this whether 60 plus 31 is 91, 91 times 1 is 91, or 176 times 0.91. We don't need to worry about those things. We can just take these figures as it is, but we must see whether these figures are correct. Whether these figures are reasonably right to assume. So she has put up certain assumptions. This is where the problem is, right? She has put certain assumptions. So this is what our Leo is asking. So here, is these assumptions all right? Can I go by these assumptions? You being expert, you be having the number experience, you will look at these things and say, yes, these figures are all right, or these figures are not all right.
Yep.
Right? So the shop has a floor area of 200 square meters. Our independent retailers with similar floor area averages annual sales of 360 million from a space of that. So they have the outside the airport, they have their independent retail shops selling their phones.
Yep.
So with a similar floor area of square meters of 200, they are selling on average 360 million, and that's the figure they have taken for this shop as a basis. So now we have to think whether is it right or wrong, right? Can we take the outside 360 million and do it? So we expect these sales to grow at 5% per annum in line with inflation. So he's assuming the inflation will be 5%. So that is why 360 went to 378 and 397. Then sales revenue based on prices charged by our independent retailers, 30% reduction is for the duty-free component. So normally if the outsiders are selling at 600, here they will sell it 30% less because that is the duty-free component. That is what they have done. Then the third one, wages are based on the assumption that we will require 6 members of the staff at any time in the shop. Since the shop is open every day 24/7, we will need 4 shifts of staff. Each will be paid 125,000 and annual cost will be 4 times 6 times 125 into 12 months, 36 million. So that's how they have got the 36 million figure. And finally she says NPV is positive and therefore we should proceed. So your attack will be on these 1, 2, 3, 4 notes and look at these figures.
And challenge the NPV.
Challenge NPV. NPV. This is what you have to do. So what I want is, before I meet you on Friday, I want you to take a little bit of time, see what are the points that you get to challenge. Look at, carefully look at, use common sense. Don't think of too much of, technical things. Just look at on the common sense and see whether, you can find some flaws in it, some problems in it, whatever. Let's discuss this one when we meet on our on Friday.
Yes. Friday, Kumar.
Yeah.
I will be working late Friday, Saturday, Sunday now. Friday, Saturday, and 6 till 9. I'm doing a part-time job in a small Chinese place, just extra money. It's cash.
Yeah.
Friday, can I meet you earlier because I'm off anyway?
Yeah. So What time is convenient for you? Friday?
Whatever, anytime before 6. So, well, finishing ideally finishing half 5 or before. So you can meet at 4 if that's all right with you.
Yeah, so we can make it 4 o'clock if you want it.
Thank you.
Yeah, so I can make it 4 o'clock on Friday, 4 to 5.
Yeah, that would be great. Yeah,
So we'll make it Friday, 4 to 5.
brilliant.
Okay. When we meet on Friday, we will decide the next week schedule.
Absolutely. Yeah.
Yeah. I'll keep it 4 to 5 on Friday for you.
Yes. So this one I'll go through with about this question and
Yeah. Yeah, you go through this question. Think about it. Let's discuss it. We will discuss it this one. But just think about this cash flow. Look at that pre-scene, what they said, the unseen, and see, look at the numbers, what they are talking about. I told you the average phone price is about $500. So we can see 360 billion, whether the figures are achievable or not. Common sense will prevail.
Yes.
So marketing department always prepares big optimistic figures. Just look at these figures. I will guide you to get through these numbers.
Yeah.
So we will meet on Friday at 4 o'clock.
Do you want me to read? You were saying you want me to anything at F1 or any E2 or sorry.
Yeah. Now I think it's good for you because I think F2 may be your weak area. F2. Start reading little bit on F2.
Okay.
Yeah, on the consolidation part of it.
Yes.
Yeah, we will do a session on consolidation 1 or 2, but start reading on F2 now.
I will do. All right.
Okay. So I'll see you on Friday at 4 o'clock.
4 o'clock. Thanks, Kumar.
Okay,
Thanks very
I'll
much.
send you the recording of this one and the last recording also together.
Thank you. Bless you.
Okay, take care.
And you take care too.
Bye. Bye. Bye.